Let's say you take $500 every month and tuck it under your mattress. To reach $1 million with that strategy, you would need to meticulously stash that cash for over 166 years. The problem with physical cash is that it actively loses its utility. When the average annual inflation rate hovers between 6 and 7%, a $100 bill buys you $6 less in goods with every passing year. If you want to actually build wealth, your money has to grow at a rate that comfortably beats that baseline of inflation. You don't need a massive lump sum to do this. You can use a systematic investment plan, or SIP. This is just a method of automating a slice of your monthly income to buy into a broad basket of market assets. When you automate those monthly slices into broad equity mutual funds or index funds, historical data shows those instruments target average annual returns between 12 and 15% over the long haul. Hitting that $1 million mark means letting go of the idea that static cash is safe and moving toward automated, inflation-beating participation in the market. The hardest part of this process happens in the first 5 years. When you check your portfolio, the balance looks stubbornly small because almost every dollar in there is cash you put in out of your own pocket. This chart shows the composition of a typical portfolio at year 5. Your principal, the blue section representing the money you manually deposited, makes up the vast majority. The tiny yellow sliver at the top represents your market returns. But this is the exact moment compound interest begins taking effect, where those small early returns start generating returns of their own. Fast forward to year 15, and the math shifts. Those accrued market returns have now grown to equal the size of your total out-of-pocket contributions. The yellow segment is doing exactly as much heavy lifting as the blue segment. And when we advance to year 30, the exponential curve takes over completely. Your manual contributions start to flatline, but the accumulated returns dwarf your original money. To hit $1 million with a standard $500 monthly investment, your actual out-of-pocket contribution will only be a small fraction of the total. The market provides the rest. Generating compound wealth doesn't require a massive initial capital injection. It just requires you to give your money enough time to multiply itself. But the math requires uninterrupted time, and the biggest obstacle to staying invested is the psychological shock of an unexpected market crash. Look at the widespread panic that hit global exchanges in late February of 2020 as the COVID-19 pandemic took hold. By March, that collapse deepened. Broad market indexes plunged, and average portfolios dropped by 25%. The immediate instinctual reaction for most amateur investors during a steep drop is to hit the panic button, pause their monthly deposits, and sell off their assets to stop the bleeding, locking in a massive loss. But an automated SIP has a built-in mathematical defense mechanism called cost averaging. Because your $500 contribution is fixed, a sharp drop in market price means that same $500 automatically buys a significantly higher volume of units at the lowest points. When you aggressively acquire units at rock-bottom prices, you drastically drag down your overall average cost per unit. When the market inevitably recovers, that massive pile of cheap units translates into a sharp spike in profit. By removing the emotional urge to sell and automating your deposits, a terrifying market crash mathematically to a highly efficient discounted buying opportunity. If you want to shave years off that $1 million target, the math offers an accelerator called the Step-Up SIP. As your salary increases over your career, you increase your monthly contribution by just 7% each year. This aligns your investments with your income raises, and the timeline shrinks dramatically without forcing you to downgrade your daily lifestyle. But before you start any of this, there is a strict prerequisite. You have to establish a baseline of wealth protection by securing term life and health insurance. Without an insurance buffer, a single unexpected medical emergency can produce a hospital bill large enough to force you to liquidate your entire portfolio. If you break open that fund early to cover a crisis, you permanently reset your compounding cycle. A 7-figure portfolio isn't built by perfectly timing a hot stock. It's built through the quiet, automated consistency of a monthly contribution, shielded by basic risk protection and given enough time to multiply.